Welcome to our financial management course. Today, we will talk about what is a bond. Specifically, we will talk about definitions, types, attributes, and risks. Let's begin. Bonds are fixed income securities that represent a loan made by an investor to a borrower, typically a corporation or government. The borrower agrees to make periodic interest payments, coupons, and repay the principal, face value, at maturity. Bonds are essential tools for financing government spending, corporate expansion, and infrastructure projects. Bond, a debt instrument issued by an entity to raise capital where the issuer promises to pay back the principal plus interest. Bill, a short-term debt instrument usually maturing in less than 1 year. Note, a medium-term debt instrument generally maturing in 1 to 10 years. Coupon, the periodic interest payment made to bondholders. Face value, par value, the amount the issuer agrees to pay back at maturity, typically $1,000 per bond. Par, when a bond's market price equals its face value. Current price, the bond's market price, which may differ from par due to interest rate changes. Maturity date, the date when the issuer repays the bond's face value. Issue date, the date the bond is originally sold to investors. Yield, the investor's rate of return from a bond. Yield to maturity, the total expected return if the bond is held until maturity, including both interest and any capital gain or loss. Treasury bonds, issued by the U.S. government, risk-free benchmark. Corporate bonds, issued by companies to finance operations. Municipal bonds, issued by state or local governments. Interest is often tax-exempt. Agency bonds, issued by government-sponsored entities like Fannie Mae or Freddie Mac. Junk bonds, high-yield, high-risk bonds issued by companies with lower credit ratings. TIPS, Treasury inflation-protected securities, adjusted for inflation. Mortgage-backed bonds, backed by a pool of mortgages. Asset-backed bonds, backed by loans or receivables like auto loans or credit cards. Convertible bonds can be converted into the issuing company's stock. Eurobonds, issued in a currency different from the country of issue. Bond indenture, a legal contract that outlines the terms of the bond issue, including interest rate, maturity date, and repayment terms. It specifies the rights of bondholders and the obligations of the issuer. Bond covenants, clauses in the bond indenture designed to protect investors. For example, a company may agree not to issue additional debt beyond a certain limit, restrictive covenant. Callable bonds allow the issuer to redeem the bond before maturity, typically when interest rates fall. For example, a company issues 10-year callable bonds, but calls them after 5 years to refinance at a lower rate. Bond indenture, a legal contract that outlines the terms of the bond issue, including interest rate, maturity date, and repayment terms. It specifies the rights of bondholders and the obligations of the issuer. Bond covenants, clauses in the bond indenture designed to protect investors. For example, a company may agree not to issue additional debt beyond a certain limit, restrictive covenant. Callable bonds allow the issuer to redeem the bond before maturity, typically when interest rates fall. For example, a company issues 10-year callable bonds, but calls them after 5 years to refinance at a lower rate. Sinking fund, a reserve account where the issuer sets aside funds periodically to repay the bond principal at maturity. For example, utility companies often establish sinking funds to ensure repayment security. Convertible bonds can be exchanged for a predetermined number of shares in the issuing company. They provide potential equity upside with bond income stability. For example, Microsoft's 2003 convertible issue allowed conversion into common shares at a set price. Secured bonds, backed by specific collateral, e.g., real estate or equipment. For example, a mortgage bond issued by a real estate investment firm. Senior bonds have priority over other debt in case of liquidation. For example, Senior secured debt of General Motors gets paid before subordinated notes in bankruptcy proceedings. Guarantees. Some bonds are guaranteed by a third party, reducing default risk. For example, municipal bonds insured by companies like Assured Guarantee. Collateralized bonds, backed by assets such as loans or receivables. For example, collateralized mortgage obligations, CMOs, and collateralized loan obligations, CLOs. Bond ratings, assigned by agencies like Moody's, S&P, and Fitch to indicate creditworthiness. Ratings range from AAA, highest quality, to D, default. For example, Microsoft has an AAA rating. Speculative companies like AMC may be rated B or lower. Market risk, the risk that bond prices fluctuate due to changes in the overall market environment. When stock markets rally, bonds may underperform as investors seek higher returns in equities. Interest rate risk, the inverse relationship between bond prices and interest rates. When interest rates rise, existing bond prices fall because newer bonds offer higher yields. In 2022-2023, U.S. Treasury prices dropped sharply as the Federal Reserve increased rates to combat inflation. Default risk, the risk that the issuer fails to make interest or principal payments. For example, in 2008, Lehman Brothers bondholders suffered massive losses when the firm defaulted. Liquidity risk, the risk of not being able to sell a bond quickly without a significant price discount. For example, municipal or small corporate bonds may trade infrequently, making it difficult to exit positions during crises. This concludes our discussion about what is a bond. See you at the next lecture.